everyone, good to see you here again. I have a couple of questions here. The first one, global markets are doing really well right now, especially for those with exposure to AI. How has Malaysia fared? Right. I actually think the investors are asking the wrong question. The real question isn't whether market have done well, it is whether the AI story has changed. Our answer is no. We have seen this year is a market led by a handful of AI and semiconductor winners. The Nasdaq, China, Star 50, Taiwan, and South Korea have all benefited. Malaysia has quietly been one of the beneficiaries as well. The Bursa Malaysia Tech Index has risen more than 20% year to date. Then come July. Even the strongest investment themes need to pause after such a sharp rally. Strong earnings were no longer enough because valuations has moved ahead of fundamentals. But here is the important point. Don't confuse price action with business fundamentals. We continue to believe the AI infrastructure cycle is still in its early innings. Demand for advanced chips, memory, packaging, testing, networking, power infrastructure remains structurally strong. One thing that encouraged us this quarter was Malaysia's resilience. Our semiconductor companies generally deliver encouraging earnings and improving order visibility, while the broader market remained relatively calm. To us, this looked like a healthy correction rather than the end of the AI story. Well, now question 2, what should investors be looking out for? I think investors should focus on separating noise from signal. The noise is the day-to-day headlines, the Fed, tariffs, geopolitical tensions, and short-term swing in the market sentiment. This event can create volatility, but they don't necessarily change the long-term investment landscape. The signal is very different. Watch corporate earnings, watch whether AI investment continues to translate into real cash flows and sustainable profits. Watch Malaysia's structural reform and domestic earnings recovery. These are the factors that ultimately determine long-term market returns. And stay diversified, stay disciplined, and use market weakness to accumulate quality business rather than reacting emotionally to headlines. Okay, finally, we come to the final question. How will Areca Capital navigate this? People often ask me whether we are worried when market fall. Actually, then that's when we become more interested, because corrections often allow us to buy tomorrow's winners at yesterday's price. Our positioning remains constructive but selective. We continue to favor long-term beneficiaries of the AI infrastructure build-out, including semiconductor infrastructure, advanced packaging, testing, and power-related companies. At the same time, we also like selective oil and gas names. After years of under-investment, we believe national oil companies are likely to resume capital expenditure to strengthen fuel supply security, creating opportunities for quality oil and gas service providers. For those who have followed Areca for a while, you are probably smiling because you know what's coming next. Our famous 3S framework. Shield your portfolio by managing downside risk. Strike when quality companies become attractively valued during market correction. And squat. Stay invested and don't let the short-term noise shake you out of the long-term opportunities. History tells us that the biggest investment mistakes are often made during periods of maximum excitement or maximum fear. Our role is to stay disciplined through both. Market will fluctuate, headlines will change, but business built on strong fundamentals continue to create value over time. That is why we don't chase headline, we follow fundamentals.